Another tough fade today, but an important lesson, I think, learned as well, which is to not hyper-focus on the role of the Japanese yen and the carry trade and what's been a more broad, economically rooted kind of destruction within the markets regime over the last month now. It really started July 10th. I'm going to get to another chart that normalizes back to when CPI came in light as the original domino that got this whole corrective process started. Yes, the Japanese yen and the carry trade turning around certainly, I think, added some fuel onto the fire, but running with any dovish language from the BOJ as a bullish catalyst, I think, is really risky, because I don't think that this is the primary force, the cause for why we got into this mess. Firstly, just look at the way the yen traded next to the S&Ps over the past 5 days. The Bank of Japan made their decision, which maybe was a little bit more hawkish and strong of a hike than some were expecting, but ultimately was part of a highly visible and well-telegraphed process to turn a ship around very slowly and change their policy regime higher. That was on Wednesday, July 31st. So that was the original pop in the yen. But check out the S&Ps. They were cruising and doing just fine. This was last week, of course. It took about 48 hours until stocks really came under pressure. And then Friday, when the employment hit light, that's when we got really messy. That's when we saw the yen pop even stronger, and that makes total sense because currencies are the definition of a zero-sum trade. So when employment came in light, right after the market had spent 2 weeks since that July 10th CPI report, rotating into cyclical stuff dependent on the economy, a bad employment report obviously was a shock and made it clear that folks were in the wrong position. It bailed out of big tech right at the wrong time. And so you already had the valuation pressure on big tech that was messing up the whole regime. And so the dominoes were already falling. The Bank of Japan didn't hurt, but as we can see, it didn't initially cause that event. When the dollar got hit, as investors started to frantically price in rate cuts following the light NFP report, that's when you had the dollar breakdown, sent the yen really higher. And then, of course, I think there's some ramifications of that. But here's also the other thing that I'm just not buying. Look at the longer term chart of the yen. It still is in this massive downtrend. We actually didn't even break out of the channel over the past 3 years to the downside for the yen. This was so well telegraphed for so long. If you were on the wrong side of it and were shocked at the way it went down, maybe understandable, you underestimated the weakness of the U.S. economy, but still, it was very clear what they've been planning to do for a very long time. And if there really was this like massive trade blowup, where are the bodies on the field? Where are the funds? I mean, this goes way higher than the VIX spike that we got from Volmageddon. That, to me, looks like this is about the economy, and that's what I talked about the last 2 days. I would think if we really had major trade disaster and hedge funds and institutions on the wrong side of the yen trade blowing up, we probably would have heard about something. You don't get VIX 60 without hearing about someone losing their job or going down. In fact, all we've heard about is Marko Kolanovic from JP Morgan losing his job. People are still talking about it. Shout out Alexander Simonova from Bloomberg. But the point here is that this looks more economically rooted. It has really for the past month. Because there's no obvious bodies on the floor from the yen trade, this, I think, can be traced back closer to the economy. What we got going back to July 10th, the CPI light, the failed rotation. I really think that's the only answer we need. The only thing that's been working since then has been the anti-beta trade. The IWM is down now. Value is down. High beta is down. The Mag 7's down. That's been going on since July 10th, which, by the way, was the same day Risk Radar took the green light off for stocks, put it yellow. That was the high for the NASDAQ. Be wary here until we either get a hyper dovish move from the Fed or some kind of really positive economic data print, maybe a big drop in jobless claims tomorrow, then the light still remains very red for stocks.